collateral tax on a sale that's maybe $1 million, where your profit is, say, 200 or 300, let's say it's 300,000.
All right.
You're going to be paying almost a third of that to 40%. You're going to pay probably about $110,000 in tax on a $300,000 profit. Now, contrast that with what you could do if you were able to take that $100,000 and use that as a down payment on another property. That's easily another $500,000 property.
True.
And if you're making 10% return on your asset, that's $50,000 a year simply by doing the 1031 exchange. And do you know what that 1031 exchange would cost you?
Thank you for joining today. Welcome to Wealth, Legacy, and Property. On this podcast, we talk about how to leverage real estate to build wealth and also leave a lasting legacy. Today, I have a special guest, Dave Foster. So Dave is a degreed accountant. Not only that, he is a serial real estate investor, a qualified intermediary, and a consultant. Dave's primary goal is to work with real estate investors by sharing his tax savings strategies with them, especially the real estate investors who wants to maximize their return. I'm so fortunate to have this opportunity to talk to Dave about tax savings. Dave is also an author, by the way. He wrote The Lifetime Tax Savings, the Real Estate Investor's Guide to 1031 Exchange. Thank you for joining us today, Dave.
Thank you, Patrick. It's great to be here. I always have to ask when people introduce me the way you did to make sure that don't hate me because I'm the accountant. I'm not the accountant that says how much you owe. I'm the accountant that loves to help you save. And that's how
exactly. Thank you. And Dave, is there anything else you want to add to the introduction?
Well, I'm just so excited to be here because your show sums up my entire life's philosophy regarding where I found myself doing, which is the 1031 exchange. We use it to build wealth. We use it to leave legacy. And it's all about my favorite topic in the world, which is real estate. So a great conversation.
Great. Then let's jump straight into it. So is 1031 exchange the best kept secret and in real estate investing? And is it just misunderstood by real estate investors?
I would say that's a really fair assessment of it. As a matter of fact, if I were to ask you, Patrick, how long would you say we've been doing 1031 exchanges?
Give and take maybe 50 years.
It's actually part of the original tax code in 1920. Over 100 years of this being allowable. But about 40 years of that, the IRS was enmeshed in a big lawsuit. And so that kept people from doing it till they knew how it was going to turn out.
I see.
And it turned out in 1996 in the favor of investors like you and I. Now we've started to see it grow. Now it's been around for over 100 years, but the IRS is not going to advertise it. So we have to educate to get people to know what's available.
That makes sense. Let's talk about your book for a second. Lifetime Tax-Free Wealth. This is really a bold promise. What inspired you to write such a book?
Yeah, that's a great question. I think originally, again, because I've built my entire 1031 career around educating people with what I have to learn in order to succeed myself as an investor. So education and knowledge for me are really the keys to success. And what I thought I started out to write was a book of education on how to do 1031 exchanges, which, by the way, in case people are listening, they're saying, what the heck is that? A 1031 exchange allows you to sell investment real estate and then within some timelines and requirements, buy new investment real estate. And if you do it the right way, you get to defer paying the tax or depreciation recapture of the asset, which means you get to take all of the profit and use it to buy more real estate. So it's like compounding your returns. So I thought I was writing a book on how to do that. What I ended up realizing, this is such a phenomenal tool for anybody using real estate, that what I actually wrote about was how to achieve your dream, whatever it is, using the 1031 exchange. So I was fortunate to have a ton of great clients over time who have all used the 1031 exchange a little bit differently to make their wealth and leave their legacy. And so we put a bunch of case studies in there from people of all walks of life who have done it, including our story. We used the 1031 exchange to buy a tax-free sailboat, move our family aboard, and live in it with 4 kids for 10 years.
Nice.
Money off the rest of our real estate portfolio and never paid any in tax.
Nice. That is interesting. So let's consider some of my audience or my clients, right? So I work with different types of clients. High net worth or affluent clients, everyday clients, even foreign nationals. In your opinion, what do you think? Let me take this back. So any investor who does not use or leverage 1031 exchange, how much is it costing them, or how much is it more likely going to cost them in the next 10 to 20 years?
Oh, so the way to calculate it's going to be slightly different on what state you pay tax in. Because the 1031 exchange doesn't just defer federal tax, it also defers all state tax. So in California, for instance, that'll be our poster child. In California, between a federal tax on a sale that's maybe $1 million, where your profit is, say, 200 or 300, say it's 300,000.
All right.
You're going to be paying almost a third of that, 40%. You're going to pay probably about $110,000 in tax on a $300,000 profit. Now, contrast that with what you could do if you were able to take that $100,000 and use that as a down payment on another property. That's easily another $500,000 property.
True.
And if you're making 10% return on your asset, that's $50,000 a year simply by doing the 1031 exchange. And do you know what that 1031 exchange would cost you?
No.
This is the secret. About $1,000. So you're going to spend $1,000 to save $100,000 and be able to make $50,000 a year more. So
nice.
You start to see why you add those up. We actually have an example that we use in my continuing education classes for realtors, where over the course of 20 years, but only 4 transactions, investors with the exact same properties starting. One does a 1031, one doesn't. And 20 years, the one who does 4 1031 exchanges, so they spent maybe $4,000.
Right.
Has a portfolio over $12 million. The investor who paid the tax and used the rest of the profit has about $4.5 million.
Okay.
The difference that the 1031 can make.
Okay. I want us to clarify something. 1031 exchange, is it just for investment properties or also primary residence?
It is only for investment properties.
Okay.
Rules for your primary residence are actually more beneficial. I mean, the greatest gifts the tax code gives us are for real estate. The 1031 exchange which allows you to sell and buy and defer the tax.
Mhm.
Residence rules, which fall under Section 121,
Okay.
would allow you to buy a property, move into it, and as long as you sell it while you have lived in it for 2 out of the previous 5 years,
Okay.
you can take, as a married couple, the first $500,000 of profit
Nice.
free.
Okay.
You can do it every 2 years. So you literally have the opportunity 8 or 10 times in your life to sell a piece of property tax free. It just doesn't get any better than that. Well, actually,
Right.
it does, because there are ways to combine the two.
I
So
see.
let's say you've got a primary residence where the gain
Mhm.
is $1 million.
Okay.
You don't have to pay tax on the extra 500. So what you do is you move out for a year
Ah.
and do a vacation rental for a year. When you sell it, you take the 500 tax free and you do a 1031 exchange on the other 500.
Great.
You can do the opposite as well, Patrick. Let's say you're getting towards retirement. You're starting to think about legacy.
Right.
Rather than sell the property and then have to pay the tax before you die, you start to convert properties from investment into your last primary residences.
Nice. Okay. Never thought of that.
When you do that, then when you sell them, after owning them for 5 years,
Mhm.
after living them for at least 2, you get to prorate the amount of gain between the years you rented it and the years you lived in it. So if
Nice.
you bought a property, used it for investment for a year, then
Mhm.
moved it for, say, 8 years, it was your
Okay.
perfect retirement house, or 9
Right.
years.
Right.
You owned it for 10, lived in it for 9,
Right.
so you would get 90% of the gain tax-free.
Okay.
Combination of those 2 statutes can be
Right. Interesting. I want us to touch on investing in multiple states, as you stated, and use California as an example. Let's say I have properties here in Chicago. I want to buy in New York. I also want to buy maybe in Texas. You know, I go about planning all of this. Obviously, it's not advisable to just get up and invest, right? We need to do a planning first. What would be your recommendation?
Well, the 1031 exchange is not a DIY. You cannot do it yourself. You actually have to use an unrelated third party, someone like us, called the
Right.
Qualified Intermediary.
Right.
So we are involved as part of your sale. We have to hold the proceeds, and
Okay.
then we are part of your purchase. So it works
Okay.
very easy to get a QI who has a nationwide footprint, because as of right now, all 50 states also honor the 1031 exchange at the state
Right.
level.
Okay.
So you can defer federal and state tax. So that's a
Nice.
beautiful thing. So then it kind of to why and what your strategy is moving from state to state.
Mhm.
So we're the part of the team that does the 1031.
Okay.
And we're talking about this at the beginning. Real estate's a team sport. And it takes
Exactly.
several people. If you're going to move out of state with your portfolio,
Mhm.
you've got a financial advisor that's talking to you about tax consequences. You've got to have a QI to do the 1031s. You need a
Mhm.
realtor to sell, probably a realtor to buy, someone who's helping you shape your whole portfolio,
Yes.
someone who has all of those people in there to
Right.
make phone calls too.
Right.
And that's how you would start
Okay.
to go through state take.
Okay. You did touch on a third party, like I want us to talk a little bit about a qualified intermediary. I think, get to it, but can we stay on that for a minute to tell us how to shop or how to look for a good intermediary, the kind of questions you need to ask such a person, right?
Yeah.
To make sure that you are picking the right intermediary.
Yeah. Are you familiar with the story of Goldilocks and the Three Bears?
No, I'm not.
There's a fable where Goldilocks was running through the forest and she found a house.
Mm-hmm.
And there were 3 bears that lived in the house. Papa
Okay.
bear, Mama baby bear. And she tried the beds on of each one of them to take a nap. Papa
Mm-hmm.
bear's bed was too big. Baby bear's
Okay.
bed was too small. Mama bear's bed was just right.
Right.
That's your search for a
Okay.
qualified intermediary. Intermediary that's going to be large enough that they have experience. The
Okay.
statute 1031 is like 2 in the IRS code, but it's
Okay.
over 10,000 of case law. So
I
you've
see.
got to have an intermediary that's large enough and experienced enough
Mm-hmm.
to have that kind of information behind them.
Okay.
Plus, the larger you are as a QI, the more you're able to scale down the price of your exchanges.
Oh, true.
So a small intermediary who does 10 or 12 a year
Mm-hmm.
be reading the manual one step ahead of you. That's not,
Right.
and because they're only doing a few, they might have to charge you for that education.
Yep.
So we set quite a bit. The largest intermediaries tend to be the cheapest.
Mm-hmm.
Smaller intermediaries tend to be the most expensive, but experience-wise matters as well. And
Okay.
then it also comes down, though, too, to because with the largest of firms, we see the trend now. You go to someone's website, at the best, you're going to have an email or AI bot chat. And maybe you get a phone number finally, but you're going to talk to a marketing rep. You're
Right.
not talking to the people who actually have the knowledge to
Mm-hmm.
help you understand what to do. And that's critical because real estate's also time sensitive, isn't it?
Yes.
You've got to be able
And,
to.
and I think it's I that a mantra I have with speed, right?
Yeah,
So that a lot of sense.
absolutely. You're looking for a QI that's large enough to have experience and economies of scale,
Right.
small enough to be responsive to you with
Okay.
senior, and that's the just right.
Great.
The law only requires that they be unrelated to you. Now,
Okay.
most of us who have gone into this are accountants and attorneys
Okay.
who are just nerdish enough that this is what we wanted to do. But
Right.
there's not a requirement on who you have to be in order to do it. So you do want to ask some questions. You need to
Okay.
ask what their level of education is, their level of experience. How many consultants do you have? Do I get direct access to a
Mm-hmm.
consultant? What are you going
Mm-hmm.
to charge? How do you hold money?
Okay.
Because that's important. You cannot have constructive receipt or actual receipt of your money. So you can't have it in your bank account.
Right.
You can't have control over it.
Okay.
So QIs will have a pooled trust account, just like attorneys, title companies, etc., where the money goes into one account that's in the attorney's name and it's pooled with everybody else's.
Mm-hmm.
Now, they will carry an insurance bond. So there's nothing necessarily wrong with doing that, except for you don't have control over if they ever use your money for something. Now, you're protected because there's insurance.
Okay.
But in my world, insurance is only good as soon as there's a problem. I'd rather
Yes.
avoid the problem. So
Right.
yeah, I ask everybody to look for a QI. There's not many out there who hold their money in segregated, dual signatory IC insured accounts in your name
Okay.
because it takes both your signature and the QI signature to move money. The IRS says you don't have control because it takes your signature and the QI signature. They also can't move the money without your permission. And so that's how you get protected at the end of the day.
That's thank you so much, Dave. As more to discuss, but for this episode, I thank you so much for sharing, priceless knowledge on your experience, audience. Thank you very much, and I really appreciate you coming.
My pleasure. Great to be here.
Thank you.